Time to go inside out on Walmart and some of the big box retailers. Jen Rogers-Kniffen, CEO of J. Rogers-Kniffen Worldwide Enterprise, is with me right now. Walmart has always been a name that you loved. Everybody who comes on loves it. Back to school. How are we doing with that? How did they do? I know people started shopping earlier. Is Walmart a winner when it came to back to school?
Well, despite your last segment on restoration hardware, there's nothing wrong with retail. There's nothing wrong with sales, and there's for sure nothing wrong with Walmart. NRF just told us that last month sales were up 6% in the industry, almost 7% actually, well over 6%. And the prior month they were up almost 6%. We are seeing a strong consumer at this moment, and whatever tariffs are getting passed through are getting absorbed right now by the consumer. But it looks like only 40 to 60% are getting passed through anyway. So stepping back and looking at Walmart, they're the best retailer in America. They're handling the tariffs extraordinarily well. They've been very careful on their pricing. Their customer service is basically perfect. Their stores look fabulous. Nobody's even close. And I don't see how anybody competes with them. How's that for an entree?
Yeah, that's pretty, obviously, you're really pounding the table on this. In the meantime, I mean, you sound very bullish on the consumer. You look at the labor picture, you look at the 1-year revisions, minus 911,000 fewer jobs were added. The last 4 months have been dismal. Layoffs have picked up. Even tariffs or no tariffs, how will the consumer keep shopping and spending? Are they going to be looking for more value? Maybe that's one of the reasons a name like Restoration Hardware, for example, didn't do as well as the likes of a Wayfair.
Well, you did notice that over that last year that we didn't have any jobs, we had fine retail sales. So we didn't have unemployment that was high. We might have not added as many jobs as we thought, but unemployment was still down around 4%, 4.1%. We're only up now to 4.2, 4.3%. The consumer is still in good shape. We don't have a big debt problem with the consumer. They still have borrowing capacity. They've been willing to spend. The lower end consumer is hurting. If you're in the bottom quintile, if you're in the lowest 20% of the economy, you're struggling. But you look at the next 3 quintiles before you get to the really rich people, and those customers are really spending, and they're doing a good job of the spending. And when you get above that, there's nothing wrong with the spending in the higher end quintile. And Walmart has had the benefit of getting $100,000 a year annual household income customers in its store, which is new for Walmart. So they've benefited from the whole thing. But we have not seen a struggling consumer over this year when we just said no jobs were really created. We're still seeing that consumer outspending, and they spent for back to school. They spent last month and they spent the prior month. Something has to happen for that not to be true. When you get to Restoration Hardware, interest rates are too high. Homes are not trading. Restoration Hardware deals in high-end furniture for high-end homes that trade, and that's not happening. But Wayfair deals with everybody at low price points.
So when you say something has to happen for Walmart to still not be the amazing company that it is, what is the wild card? Is it recession-proof? Are you worried about a recession? Is there anything to stop Walmart in the next 6 to 12 months?
No, unless the consumer has a big problem, which is what I was referring to. No retailer is recession-proof. The economy's not recession-proof. You know, economics are real. If we had a big recession, everybody would struggle. Would Walmart handle it better than other people? Yes. Would it hurt them? Absolutely. I don't think we're going to have a recession. I think we're about to start lowering interest rates. But if you think the economy is cracking, then retail is not a fun place. But if you don't think that, and I don't, I think we're going to see continued strength right into 2026. Are the tariffs an issue? Yes. Are they a real problem? Is it stopping the consumer? Is it tearing up our ability to make a buck? It is not. The retailers are still performing well, and the consumer is still performing well. And I don't think we're about to see a big explosion of problems from tariffs. We've started to deal with them pretty well already. Retailers are pretty agile. When they find out there's something they have to do, they go do it. They've been moving supply chain, they've been renegotiating deals, and yes, they've been raising some prices. But I don't think we have an inflationary problem driven by tariffs, and I don't think we have a stalling economy. But I do think we're having cracks in the labor market, which I think that the Federal Reserve is about to try to fix. And I sure hope they move in September, because they need to get down by about 100 basis points if we're going to get to stability. And they haven't started that process yet.
Walmart versus Amazon when it comes to e-commerce. E-commerce growing. How much is it growing? Which of the two becomes the winner in the next few years? E-commerce is where it's at. Is that the vibe?
Well, yes, but you don't have to worry about who's the winner between those two. You have to worry about everyone else, because Walmart and Amazon are going to win. And yes, they are each other's biggest competitor in the space, but it's other people that are losing market share. Walmart's numbers are really good. Every month on store-for-store sales, somebody loses market share. Amazon's numbers are very good. Every month on sales growth, somebody loses market share. But those two are taking market share. That's not about to slow down.
Jan Rogers-Kniffen, J. Rogers-Kniffen, Worldwide Enterprise. Jan, thank you. Always great to see you, and keep doing all those channel checks for us too. Always has all the details on all the retailers. So Tom White, host of Fast Market, is with us, and you have an example trade for Walmart today. We want to see more about this.
Yeah, Nicole, stock's still just off of those all-time highs above $105 a share. But if you look at the chart on it, it's just kind of in consolidation phase. It really hasn't broken out. So I looked at a strategy that maybe takes advantage of this continued consolidation, maybe gives you some upside exposure, but maybe still owning the shares, right, to collect that 0.9% dividend yield that they have. Not a very big one, but it's something, right? It's a pay-to-wait type of strategy that I'm looking at here. So a covered call strategy. So for every 100 shares of stock you buy, we're going to sell an out-of-the-money call. I went 21 days out to the October 3rd weekly series and sold the 105 strike call. So creating this 100 shares of stock, you sell one call against it as a position. You're going to pay roughly about $101.80, maybe about $102 is where it's trading now. But the debit you pay is also going to be your break even, right? So you're buying the shares at a discount because you're selling that upside call there. You can see here from the risk profile what that looks like. You've got a lot of risk if the stock goes to zero, right, to the downside, because you own the shares in this position. As you get closer to expiration over the next 3 weeks, the idea is to buy that short option back and sell another one against your long stock position. What this does is creates yield on a week-to-week or month-to-month basis, depending on how far you go out. You can change the strikes also if the stock does continue to move to the upside, maybe gets to new all-time highs. Maybe you'll want to adjust the strike, but this might be the way to play it. It's a paid-to-wait type of strategy. You collect yield on the calls that you sell against your stock. And because you own the stock, you get to collect that dividend yield on a quarterly basis.
Walmart just really has been such an incredible performer. I mean, over 1 year up 31%, but as Jen Rogers-Kniffen really noting, I mean, barring something really happening, just what an incredible leader it has been. Then there's Amazon, and he said he's not worried about neither Walmart nor Amazon, particularly when it comes to e-commerce. You don't have to worry about a thing. Let's talk about Amazon, because you have an example trade there.
Yeah, it's up, a modest, 4% so far this year. There's some news out on it today. The FTC might be investigating Amazon and Google for their advertising practices, which is why it's down just a little bit on that news that just came out of Bloomberg about 10 minutes ago. So under a little bit of a pressure, but still just off of those all-time highs, about 5% off of those all-time highs that we saw earlier this year. So I looked at a strategy, and the risk profile, Nicole, is going to look the same as a covered call position that we just looked at in Walmart, but Amazon doesn't pay a dividend. So how do we create a neutral to bullish strategy using Amazon while still giving ourselves a cushion to the downside? They're not immune to market moves or pullbacks in the market or in the stock itself. So I looked at a cash secured put position in Amazon. And as I mentioned, the risk profile is going to look exactly like a covered call, but you don't own the stock in this one. This is just selling an out-of-the-money put. So I went out to that same October 3rd weekly cycle, 21 days to expiration, and just sold the out-of-the-money 220 strike put. You're going to collect roughly about a $2.25 credit on it. That's what you can make on this trade, $225 per spread. But it takes your break even down to $217.75 to the downside. So you've got a 5% cushion before you get hurt on this type of trade where you start to lose money. Now, this is twofold type of position, right? You don't own the shares. You're just selling that out of the money put to collect the option premium. You either get to keep that option premium of $225 per put you sell, or if the stock does fall below 220 into expiration over the next 3 weeks, you'll be able to buy the shares at a 5% discount to where they're paying what they're trading at right now, which is about $229 at this point. So twofold type of trade. You're either willing to buy the shares at that 5% discount, or you just get to keep that credit that you collected with a nice cushion, and your probabilities are better on this one. You've got a probability that that 220 strike will be out of the money at expiration of over 70%. So the odds are in your favor.
All right. Well, Tom White, always great with the example trades. Always love having you on. And Morning Trade Live giving us a look here at both Walmart and Amazon today.